Here's a very detailed summary of the book, The Intelligent Investor by Benjamin Graham. The Intelligent Investor, a Core Philosophy. At its heart, The Intelligent Investor is a guide to a disciplined and rational approach to investing. Benjamin Graham's central thesis is that the intelligent investor is not a person with a high IQ or a brilliant trader, but rather someone who is patient, disciplined, and emotionally stable. Graham emphasizes that the key to long-term success isn't about beating the market or finding the next hot stock, but about avoiding serious mistakes and preserving capital. He teaches that a good investment is not based on speculation, but on a thorough analysis of a company's fundamentals. The difference between investing and speculating. Graham makes a very clear distinction between investing and speculating. An investment operation, he says, is one that, upon thorough analysis, promises safety of principal and a satisfactory return. Operations that don't meet these criteria are considered speculative. Investing is about owning a piece of a business, understanding its value, and buying it at a price that offers a margin of safety. Speculating is about trying to predict the direction of the market, or buying a stock because you believe its price will go up, regardless of the underlying company's value. This is driven by emotion and hope, not analysis. Graham advises readers to never confuse the two. He isn't against speculation entirely, but he insists it should be kept separate from your core investments, with a small portion of your portfolio, and only if you fully understand the risks involved. The two types of investors, defensive versus enterprising. Graham categorizes investors into two main types. The defensive investor. This is the investor who wants to put in minimal time and effort. They prioritize safety and freedom from bother. Their strategy involves creating a diversified portfolio of high-quality, large, and financially strong companies. They are less concerned with finding undervalued gems and more focused on a simple, consistent strategy that will deliver a satisfactory return over time. This approach often involves investing in a balanced mix of stocks and bonds, and periodically rebalancing the portfolio. The enterprising or aggressive investor. This investor is willing to dedicate significant time and effort to researching and analyzing securities. They are actively looking for special situations, undervalued stocks, and other opportunities that the market may have overlooked. This is a more hands-on approach that requires a deep understanding of financial statements and a willingness to go against the crowd. Graham is clear that most people fall into the defensive category, and that's perfectly okay. The book provides specific guidelines and criteria for both types, helping you determine which path is right for you. Mr. Market, your temperamental partner. This is arguably Graham's most famous and powerful analogy. He asks you to imagine that you and a partner, Mr. Market, own a business together. Every day, Mr. Market comes to you and offers to buy your share of the business or sell you his at a price that changes daily. Sometimes Mr. Market is incredibly enthusiastic and optimistic. He will offer you a very high price for your share. Other times, he is depressed and fearful. He will offer you a very low price. The key insight is that you are under no obligation to accept his offer. You can simply ignore him and continue to own your piece of the business. Graham's message here is that the stock market is often irrational and driven by mood swings. The intelligent investor doesn't let Mr. Market's wild fluctuations dictate their actions. Instead, they use these fluctuations to their advantage, buying when Mr. Market is fearful and prices are low, and selling when he is greedy and prices are high. This teaches you to use market volatility as an opportunity, not a source of fear. The margin of safety, the cornerstone of value investing. The margin of safety is the most crucial concept in the entire book. It's the principle that an investor should only purchase a security when its market price is significantly below its intrinsic value. Intrinsic value is the true underlying value of a company, based on a careful analysis of its assets, earnings, dividends, and future prospects. Margin of safety is the difference between the intrinsic value and the current market price. Graham uses the analogy of building a bridge. You design a bridge to carry a certain weight, but you build it with a much higher strength capacity to account for unforeseen factors and errors in your calculations. The same applies to investing. By buying a stock for much less than it's worth, you give yourself a cushion against potential mistakes, unexpected bad news, or a downturn in the company's performance. It's the key to protecting your principal and a cornerstone of defensive investing. The importance of bonds and portfolio allocation. Graham dedicates a significant portion of the book to the role of bonds and the importance of a balanced portfolio. He recommends a simple rule for defensive investors. A portfolio should be split between stocks and bonds. The ratio can vary, but a 50-50 split is a good starting point. This allocation provides stability and reduces overall risk. During market booms, as your stock's value increases, you would sell some and rebalance to maintain your desired allocation. Conversely, during a downturn, you would sell some bonds to buy more stocks at lower prices. This strategy forces the investor to buy low and sell high without having to make emotional decisions. The problem with market forecasting and hot stocks. Graham is highly skeptical of market forecasting and the pursuit of hot stocks. He argues that nobody can consistently predict the future direction of the market or which company will be the next big winner. Instead of trying to outsmart the market, the intelligent investor should focus on what they can control: their own behavior, staying calm and rational in the face of market swings. Their analysis: thoroughly researching a company's fundamentals before investing. Their portfolio: building a diversified portfolio with a clear allocation strategy. He cautions against following popular advice or fads, as they often lead to buying high and selling low. The focus should always be on value, not popularity. A simple framework for defensive investing. For the defensive investor, Graham offers a clear and straightforward set of criteria for stock selection. Adequate size of the enterprise. Look for large, prominent companies with a long history of successful operation. A sufficiently strong financial condition. The company should have a strong balance sheet with a reasonable ratio of debt to equity. Earnings stability. The company should have a history of consistent earnings, with no losses over a set period, e.g., the last 10 years. A long record of dividend payments. Look for companies that have paid dividends for many years without interruption. Growth of earnings. The company should show some evidence of consistent growth in earnings over time. Moderate price to earnings, PE ratio. Don't overpay for a stock. Graham suggests a PE ratio below a certain threshold. Moderate price to book value, P/B ratio. Similarly, the price of the stock shouldn't be too high relative to its book value. By following these simple rules, the defensive investor can build a portfolio of strong, stable companies that are less likely to cause them grief and are more likely to provide a satisfactory long-term return. In conclusion, The Intelligent Investor is not a book that tells you which stocks to buy. It's a book that teaches you how to think about investing. It's a timeless masterpiece on investor psychology, the importance of discipline, and the power of a conservative, value-based approach. The core message is clear. Control your emotions, think for yourself, and focus on the fundamental value of a business, not the whims of the market. Thanks for watching. If you found this summary helpful, I'd really appreciate it if you could subscribe to the channel. Hitting the like button helps others discover this content, and leaving a comment lets me know what you'd like to see next. Don't forget to click the bell icon so you're notified every time I upload a new video.